Hey folks, welcome to Verified Investing. My name is Gareth Soloway, Chief Market Strategist here. So today we're going to discuss why the market is rallying. And really, we talked about this last week, that being a holiday week, it's very unusual to see selling. Now, why is that? Let's talk about that. So number one, institutional money, the big traders worth millions, hundreds of millions, even billions of dollars, they are already on vacation. And so when you take away those big traders, the ones that might be unloading during this period, it leaves retail. And retail generally is buying the dip. They're buying, they're going long. Very few retail investors short the markets. And so ultimately, that gives a neutral to upside bias to the market on light volume weeks, AKA Thanksgiving week, which we're in now, and also around the Christmas holiday as well, right? So think about that. Now, number two, there is a key component that's driving the markets up. Let's take a look at this here. So, number one, we have this. This is the Fed Watch tool. Now, the Fed Watch tool last week showed that we were unlikely to see a rate cut in December. But you can see highlighted in the green box that it's now at a 79.1% chance of a Fed rate cut in December at the December 12th, 2025 meeting. So the meeting that's basically 2 to 3 weeks away at this point. Okay, so the fact is the market is craving, and I repeat, craving cheap money, especially as long as the economy is looking okay. So remember, we heard many Fed officials talking hawkishly recently. But recently, just in the last couple days, some Fed officials have opened the door for a rate cut in December. So it went from no rate cut expected, the odds were about 30% chance, which is very low, to now almost 80% chance we will see a rate cut in December coming right up. The markets love that, especially with the latest economic data that shows the economy slowing a little bit, but actually is kind of bottoming out, maybe ready to reaccelerate. I don't think that's going to happen, but that's what the near-term data is showing us. Now, we have to also look at the charts, right? We have to look at the charts and put it in a framework so we can understand the technicals. Remember, verified investing is all about no BS, just charts. So let's take a look here. Let's look at the charts and see what we have. If we bring this up, we can see very, very clearly that the chart is still on the S&P stuck within this parallel. Now, sure, we're getting a bounce today. You can see it right there. If I flip from the weekly back to the daily chart, we're actually having a good day. The S&P is up 1.64%. Albeit on lighter volume as big money is away on vacation. But still, it's a good gain. But if we go back to the weekly chart, as long as you are below this high cycle pivot trend line of the parallel, and notice again, for those of you that are new, this isn't an arbitrary parallel. It literally takes the low of 2020, the COVID low, to the bear market lows right through 2022 into early 20 and late 2023, and then to the liberation sell-off low here. We then take a parallel line, and you can see this is parallel, right? So this was a trend line. We bring up a perfectly parallel trend line right to the highs of the bull market in 2021. And what does it give us? It gives us the highs recently. And so as a technician, if your pure purpose like me is to be unemotional and be robotic, what would this signify up here? It's major resistance where likely, like we saw here, this could be a much bigger sell-off than just a small pullback of around 6%, which is what we were at the lows last week. All right, so even if we rally up here, we could rally all the way back to all-time highs, and we still would not break this parallel. Now, if we break above it, all bets are off. Markets could float up, melt up, whatever you want to call. But as of now, this is the line in the sand. And what's so interesting about this, folks, is that this same sort of pattern, this trend line here, and showing how we can go back and hit the line and then get rejected, then hit the line, get rejected. This is something we've actually just seen in Bitcoin this year, a great example of. So imagine this, folks. Let's do this case study. So here you have a trend line going back to 2021, a parallel right here. And the idea is, can we pull back? Can we go up here, reject it again, go up here, reject it again, and then get a bigger pullback? And you might say, well, that's really unlikely. If we keep on hammering and making new all-time highs, wouldn't the market just blast off? Well, look at Bitcoin here. Let's flip over to the Bitcoin chart. I want to show you this. So I'm going to remove all of these other ancillary lines because I don't want us to pay attention to anything but this here. This, my friends, and this is really, really important, folks. You ready for this? So this is the Bitcoin daily chart. This is your high from 2017, so your bull market high. This is your high from 2021. All right, the first bull market high of 2021. And then look at over here. If we go to our daily chart, right? Here's our daily. We came up to the line like the S&P did, and it got rejected. And then we had this big push up, and it hit the line again. What happened? It got a bigger rejection. Then it kind of meandered, came back again, and look, it got rejected for a third time with a big drop to it. Do you guys see that? That's amazing, right? And so the point being is that if we go back to the S&P 500 chart, all right, let's flip over to this chart here. In fact, let's go back to the daily chart. We could, in theory, do the same thing. Here's your rejection. Here's your first rejection. And we've gotten a small 6% pullback. We could go here, reject it, and let's say it's a little bit bigger, right? Let's extend the chart out. Then we could come back up, even hit it again, and this is where the bigger fall. And by the way, I don't want anyone to think that I'm saying we have to go back and touch this. My point is to respect the trend line until proven otherwise. Listen, if it takes it out and confirms above, amazing. It's off to the races. But if we look at the Bitcoin chart, which is human nature, right? I mean, whether you're trading Bitcoin stocks, the S&P, or gold, human emotions driving it, right? Greed and fear, back and forth. And so what we can see is that you can actually chop around and even tag the line multiple times and still get rejected. And in fact, the third hit in the case of Bitcoin resulted in the biggest move down, one move that I don't actually think is over just yet. Remarkable, folks, okay? So just keep that in mind, is that while we are bouncing today, and it's a great bounce, nothing against it, about a 1.6% bounce, unless we take out this parallel here, this high here, then this is now still at its upper band ranges. And really, as a bull or a bear, doesn't matter. You have to respect the trend line. Looking at the QQQ, big bounce on the Qs today. Look at this, up 2.65%. But number one, this reversal last week was epic. This was on the back of NVIDIA, which gapped up and then fell apart. NASDAQ, look at that wide range, nasty red candle. And number two, we have this parallel, which is a much shorter parallel, but this is going to be just epic resistance right here. If we get back there, the idea is this should get rejected on price. All right. And then I just wanted to go over one other thing here. There's a couple other things, in fact. So we talked about the Fed watch tool, right? We talked about the Fed watch tool now pointing to a cut in interest rates in December. Well, if we look at the 10-year US yield, look at this. This is confirming it, right? We were trading within this zone from these lows. Look, 1 hit, 2 hits, 3 hits, 4 hits. And now we're breaking. And then up here, we had 1 hit, 2 hits, right? And so it was very clear we were just chopping. But because expectation of rate cuts is increasing, we're now breaking lower on the 10-year yield, and the market likes lower rates. The dollar, which isn't doing much, it is just consolidating under resistance. But another thing that I've been watching, and I did a video on this last week, the 10-year yield in Japan was popping, which is one of the reasons. Listen, the media really didn't cover this, but this was probably one of the main underlying factors for the market fearing and selling off. And if it starts going up again, be ready for that, because that can happen again. But the 10-year yield on the Japanese 10-year here, this has pulled back, which is good, because when you have a spike in yields and a country has a 240% debt to GDP, rising yields means interest payments are spiking because, again, there's that much debt. This actually could cause a major black swan event. But again, it backed off recently. We have to monitor this, guys. This is going to be big, but that's something I'm following. And then lastly, we have to revisit this chart. This is your chart of the SMH. Now, why the SMH, right? Why? If you've watched my videos, you already know. But the SMH, my friends, is the semis, which is the AI trade. It is literally the reason why the S&P has gained 75% of its upside in the last 2 years has been specifically due to the AI trade. It just is. I mean, NVIDIA, Broadcom, I mean, you name it, right, across the board, AMD, etc. In addition, 90% of GDP right now is CapEx from AI. That's scary alone. But more importantly, the chart. If we look at this chart in 2021, look, the SMH exactly 102% above its weekly 200 moving average. Look at the extension move right there. It then corrected 45% back to home base, the 200 MA. Then in 2024, we got 102%, exactly 102% above the weekly 200 MA. It corrected 40%. Lo and behold, right up here, guys, we just got up a few weeks ago, now 4 weeks ago, 102% above the weekly 200 MA. And look at the pullback. Now we're getting a bounce, but that makes sense, right? Look at this. Look at this right here. This is actually amazing. 1 week down, 2 weeks down, 3 weeks down, bounce. 1 week down, 2 week down, 3 week down, bounce. And so you can see there's a method to the madness here on the charts, right? There's, again, when you get these extension moves, you have a pullback, but it doesn't go straight down. It then bounces, oftentimes chopping, and eventually winds up coming back in. So really what we are seeing here, we might even see something like this, then like this, and then again, eventually making its way back to the 200 moving average here. All right, to summarize, guys, the markets are getting a bounce. Again, last week I talked about how this week, holiday week, big investors on the sidelines due to being on vacation for Thanksgiving, traveling, whatever it may be, neutral to upside bias. We're seeing a nice little float in the markets, good rally in the markets. However, the charts tell us that right now you should expect further downside, maybe as early as in early December after this holiday week or so, going into December. We'll have to see once we get close to Christmas, neutral to upside bias likely again. But again, as of now, the charts remain in a very cautionary situation. Red lights are flashing. Bounces at this point, because we're so close to these extension moves on the S&P, on the SMH, they are selling opportunities, at least to me. All right, guys, there's my 2 cents for the day. Thank you so much for tuning in. Don't forget, today's Green Monday. That means every course on our website, 50% off. My Winning Trader series is 50% off. Everything I know up here is in that course. Go check it out, guys, at verifiedinvesting.com. Take care.